We know about trends or other opportunities before anybody else does, so we can mitigate a lot greater risk. It's kind of like being insider trading in the stock market. If you knew everything that was going to happen, you'd have a competitive advantage. So that's the kind of correlation we're willing to accept.
This is Durable Value. Get investing and business insights from industry experts and successful entrepreneurs every week. Like and subscribe now.
So today we're here talking about Ray Dalio's concept of the Holy Grail of Investing, and that his video is available on YouTube. But essentially it talks about this idea that if you have one asset that has a 10% return, or you have a basket of 15 to 20 assets that have a expected return of 10%, and how you get a greater return overall by having that basket of assets. So it's this idea of diversification, and the lower correlation you have, the greater the expected return.
So that prompted the question, what does this look like for real estate? And what does this look like for our portfolio? And I think that's what we're going to talk to today. Let's start with the first idea, which is that invest in areas where you're smart. So we start by having a very correlated approach to where we invest, and that is we invest in Northern California very specifically. And so we start by working in an area that we've been in a long time, we have a lot of relationships in, and we understand very deeply. Any thoughts on that?
Yeah, so on the one hand, that is correlation by definition, right? We're buying assets that are in a very specific geography. But that's a correlation we're willing to accept, and the reason is because we're trading risk because of our knowledge. We're market experts in that geography. We know the ins and outs. We know about trends or other opportunities before anybody else does. So we can mitigate a lot greater risk. It's kind of like being insider trading in the stock market. If you knew everything that was going to happen, you'd have a competitive advantage. So that's the kind of correlation we're willing to accept. So how do we then apply that to decorrelating as we're buying in our portfolio?
I'd start with adding one more thing to the correlation side, though, which is that there's about 20 broker relationships in the various markets and submarkets. And every week we get a fountain of deals, most of them off market, that we then select from. So we have a broad geography that's and group of people that are very invested in ours and the firm's success.
So on the decorrelating, we start by looking at our portfolio, and we look at our portfolio and the various assets that we have. Apartments, office, retail, industrial. And we're balancing both the current return profile, because if we can invest in a particular asset but it yields a low return, that's not an asset that we're pursuing. But then we also look at, do we have too much concentration of a particular type of product?
So we tend to invest in themes. So we allocate by asset type, but we think of themes first. What are the trends that we want in our portfolio? For example, during COVID, large populations moving from the Bay Area towards Sacramento. That was a trend that was happening before COVID, but was exacerbated during COVID. How about office tenants moving from downtowns into adjacent submarkets? That's a trend that we've been working on for a long time.
Another counter trend is during COVID, I think everybody spent more time on Amazon, more time buying. And because of that, the in vogue or in favor asset type was industrial, or is industrial, and that continues to be bid up to these levels where we feel like the return that we're able to garner for the risk that we're incurring isn't worthwhile.
Or diversified shopping centers. We're not currently investing heavily in shopping centers, but we currently own shopping centers and previously invested in shopping centers with large government tenancies, because those are very sticky, healthcare, dialysis, restaurants, everyday use, salons, and that sort of thing. But creating that right mix too has also been great. So we start with being in an area we're smart, adding themes to that, and then allocating in advance. So as we plan for our next year, we think about how are we going to allocate? How much office? How much retail? How much industrial? How much multifamily? So.
And so this next year, we continue to see the theme of office space uncertainty playing out. So we think that that's a worthwhile theme to invest in. We see a tailwind in our market as it relates to multifamily as people move out of the urban geographies adjacent to the Bay Area or Southern California, and they move into our geography. So those are a couple of themes that we're investing around coming into 2021.
So at this point, we diversify by submarket and asset type. So within our geography, there's dozens and dozens of submarkets, and we hopscotch a little bit. We find ones we believe in, we invest, and we incubate there, and we learn. So for example, in Greater Sacramento, we've got a few buildings in one submarket, and currently we're working on a building in Folsom. And we're going to let those other buildings incubate. We're adding tenants, we're de-risking them, we're improving the assets, and we're working on another submarket. And at the same time, we're watching this one closely and we're learning. And then we might switch back, or we might move over this way a little bit. But we keep triangulating in on themes and assets that really work for us, and we work to be at the very leading edge of those themes. And because we're actively investing all the time, we're on the front end of these trends, and we see them before other people do.
We also look at kind of I guess you could say, the class of the neighborhood. So whether it be, in this case, office or multifamily, at other times, other assets, we look at times we want to be in a neighborhood that is higher income, more affluent, because that brings some level of risk profile. But then we also look at neighborhoods that are more working class or more class B, because that provides some diversification as the market changes.
Yeah, so especially on multifamily right now, we're working at more, a little bit more working class, or a little bit more middle market, because there's a lot of other groups that are chasing the higher end. So we're seeing more opportunity there. But in everything we do, we work to go in and make it more valuable and more desirable than what we started with. So commonly we'll look for an asset that doesn't match its geography, an asset that's a few steps behind its location. And our job is to take that asset which has been neglected and bring it up to being worthy of its location. So that's another key part of our investing, is that we add value to everything we do. So there's a riding the top of the wave, which is riding the macro trends or the micro trends. But then there's the activist, the value add, the middle of the wave, where we have a top line trend we believe in, but then we go in and we take something that we can buy at a discount because of current problems that we know how to solve. So now we've got what we believe is a tailwind, or a wind at our backs pushing us with the macro, and we've got an activist strategy that we're really good at doing, and that de-risks the opportunity.
Yeah, absolutely. And I'd say one other layer of our kind of decorrelating assets is tenant mix. We're very conscious about the type of tenants, particularly as we're working in office or in retail or in industrial, the type of industries that they're in. And as much as possible, we try and cultivate a diversification in that asset base. So for instance, we made a large investment into a single tenant state of California leased building. But then we also, a few months later, we made an investment into a building that has a lot of, you could say, maybe mom and pop offices. So you get that decorrelation between those two different industries.
Right. Well, what's important is that we're working more than one strategy at a time. So with the single tenant large state asset, well, it's a headquarters building, it's brand new. There's a lot of reasons we really believed in this asset, but at the same time, it opens up a broader relationship with the state, which will keep working for many years to come, in addition to 4 or 5 other office strategies. So it gives us another golf club to swing, so to speak, or another option. Well, I think maybe we end with the Ray Dalio idea of do the simple thing. Find 15 to 20 uncorrelated return streams. And in many ways, that's our strategy. 15 to 20 uncorrelated return streams. Now, we're not uncorrelated in the same way that Ray is, but we're also activist in that we're actively adding value to the assets that we have. So,
and to borrow from Warren Buffett, better to have a few eggs in the basket that you watch very closely, than to have a plethora of eggs that you can't watch so closely.
Thank you for listening to Durable Value, an investor's podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit CrescedaPartners.com, where you'll find more information, investors' tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.